My name's Warren Dueck, and I'm with Steve Flynn. We're both partners at Andersen Tax LLP, and we're going to talk to you about the tax in the U.S. called the Global Intangible Low Taxed Income, or GILTI. So GILTI is going to have a major impact on U.S. persons, businesses that own corporations outside the United States.
Well, it has a real big impact on those U.S. persons that control those non-U.S. corporations where they have more than half the votes or value. This is a tax on the profits of that corporation, regardless of whether they're distributed or not to the owners.
What is the GILTI portion of that?
Well, it starts with a calculation of the annual profits within that non-U.S. corporation. So to the extent that those profits exceed a base amount that you're allowed to earn, those profits are subject to tax in the hands of the individual owners in the year that they occur.
So they don't actually receive the cash, but they end up paying tax on it. And that would be true of a U.S. corporation or a U.S. citizen or U.S. resident, and would include a U.S. citizen in Canada that owns a Canadian corporation.
Well, and think of the problems with that, because you've got the Canadian corporation paying tax on that income already, but as well as that U.S. citizen resident in Canada, that individual is paying U.S. tax on the same income. And so you got two different taxpayers paying tax to two different countries at the same time.
So let's just think about that. I mean, the Canadian corporation pays Canadian corporate income tax. The U.S. shareholder living in Canada or in the U.S. or somewhere else pays U.S. tax. And then the Canadian corporation distributes the earnings and pays Canadian tax again, and potentially a tax in a third country.
Well, that's correct. These rules are complicated, and if you think of where they were trying to get to, this was supposed to be a tax on intellectual property with multinational and Fortune 500 companies. Those kinds of companies like Apple and Microsoft, who had rights and property overseas paying a low rate of tax. And the idea was that this deferral of income tax from a U.S. perspective shouldn't occur anymore. But the way these GILTI rules were written, it really affects far more of a broad-based population.
So it's not just intellectual property that it affects any corporation that doesn't have, or the shareholder of any corporation that doesn't have hard assets or has a limited amount of hard assets. The idea is, Starbucks has a copyright on the Starbucks logo, and that's worth a lot of money, and they charge for that. But there's no hard asset behind it. It's an intellectual property.
Well, that's right. What the GILTI rules allow one to do is calculate those profits in a corporation, and to the extent that they're tangible assets in the corporation, fixed assets, hard assets, you're allowed to earn a certain rate of return of 10%. Anything above that 10% is subject to this GILTI tax. And so you have this situation where, for example, professionals who are in Canada have a real awful situation when it comes to the GILTI tax.
Professionals like?
Well, take doctors or dentists, for example.
Okay.
They'll have a professional corporation. That's a very common thing you use in Canada. However, they won't have a lot of tangible assets in that corporation.
They got a few chairs and desks and a computer.
Think of a lawyer that's got a couple of some office furniture, but they don't have a lot of hard assets or tangible assets. What they have, though, is a high amount of profits, and so the majority of those profits will be subject to this GILTI regime.
So, you don't have to have intellectual property being affected by GILTI. You've got kind of multiple layers of tax, and potentially you have a tax liability approaching sometimes maybe 80 or 90% unless you actually find a solution for that.
Well, that's right. And the instinct might be to say, well, we'll just pay dividends out of that Canadian corporation and we'll use the credit in Canada to offset the U.S. tax. However, the GILTI rules prevent that. And so you get into these situations where you have this really high rate of tax.
They prevent you from paying a dividend, or you just can't claim a credit?
You can pay a dividend, of course, but that credit that you pay in Canada, you cannot use that to offset your U.S. tax. And so you're paying tax to two countries on the same income at the same time, and this is where we get these high rates of tax approaching 80 or 90%.
Double taxation,
Absolutely.
Essentially. Yeah. So what do we do to solve that?
Well, there's a number of planning techniques one can use. If you look at the profits in the corporation, if you want to have a real simple solution, if the corporation doesn't have any profits, then there wouldn't be any income in that corporation subject to GILTI. And so one thing individuals or corporate entrepreneurs can do is they could pay out a salary or pay out fees to themselves to wipe out any profits in the corporation and therefore not be subject to GILTI.
Now, that kind of creates an interesting problem. I mean, that's a simple solution, but U.S. tax law also kind of rebels against that notion, saying that you can strip out profits as salary because of the reasonable compensation rules in the U.S. So, you know, even where there's a solution, sometimes there is a counter problem associated with it. You know, so this really creates issues for us.
Well, it does. And even from a Canadian perspective, a lot of entrepreneurs would say, well, I don't really want to take out all of my profits in the form of salary and pay tax at high rates in Canada, which can approach or exceed 50%. A lot of entrepreneurs who are trying to grow their business want to leave profits in the corporation.
Yeah, it's defeating the purpose of having a corporation because you're not getting any deferral then in that respect.
Well, that's right. So we often look, Warren, for other types of solutions to try and to manage this GILTI problem.